Big moves in the copper market, silver hitting a new record. Hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli. Look at these headlines. Mercuria withdraws huge volume of copper from LME as prices soar. It is that kind of year, isn't it? This is Bloomberg News via mining.com. Let us see what is going on here. Mercuria Energy Group has ordered about $500 million of copper for withdrawal from warehouses overseen by the London Metal Exchange as the trading house positions itself for a global supply crunch fueled by possible U.S. tariffs. Now, we've seen this happen before. Remember when the futures price bounced off $6 earlier in the year? Now, we are hitting new records here, but from what I understand, it is the spot price and not the futures price. The firm, Mercuria Energy Group, was the key party involved in requests to withdraw about 50,000 tons of copper from LME depots on Wednesday, according to people familiar with the matter who asked not to be identified discussing private trading activity. The cancellation of stock was the biggest seen in more than a decade, and it helped drive prices towards record highs above $11,500 on the LME. So it looks like some sort of arbitrage or traders positioning themselves for the potential of tariffs on copper again. Now, when stock is canceled, as it says here, that means it's being taken for delivery. And it continues. Copper pricing dynamics and trade flows have been upended since President Donald Trump in February announced plans to place tariffs on the metal in a bid to boost U.S. supply. The decision caused futures in New York to spike above those on the LME and spurred a record surge in U.S. imports as traders including Mercuria, Trafigura, and Glencore capitalized on the arbitrage. The trade was interrupted in late July after Trump unexpectedly spared commodity-grade forms of the metal from tariffs, but in recent weeks, trading houses have again been racing to ship more metal to U.S. shores. Crucially, Trump has pledged to revisit plans to impose duties on primary copper next year, and a fresh surge in New York futures has provided another opening for traders to front-load imports before any levies come in. And Costas Bintas, who joined Mercuria last year, so we discussed Costas Bintas last week, and I believe it was at Shanghai Copper Week, where Costas was giving a speech, and it's going to be quoted again here, and it's worth mentioning. Costas Bintas, who joined Mercuria last year to spearhead a rapid expansion into metals markets, told Bloomberg last week he expects prices to push deeper into record territory in the weeks ahead as the trade gathers steam, with buyers outside of the country potentially facing critical shortages in the first quarter of next year. Yes, you heard that right. Critical shortages. Quote, "This is the big one," he said in the interview. "If the world keeps going like this, we will be left without copper cathodes in the rest of the world." A spokesperson for Mercuria declined to comment on the request to withdraw copper from the LME. So the same group that Costas Bintas is a part of is now withdrawing copper from the LME. Bintas's bullish call is the latest prediction that a long-anticipated surge in copper prices may finally be about to occur, with executives at rival trading houses IXM, SA, and Gunvor Group also warning in recent months that a string of mine disruptions risk creating supply shortfalls. Copper's push into record territory comes despite a softening outlook for demand, particularly in top consumer China. But Bintas said he expects that manufacturers will need to pay increasingly high prices as shipments to the U.S. accelerate and exchange inventories dwindle. Traders routinely take and deliver large volumes of metal from the LME's global warehousing network, which is designed as a market of last resort during periods of shortage or oversupply. The large majority of the metal underpinning the LME's copper contract is of Chinese and Russian origin, which can't be delivered against contracts on New York's COMEX. But there are growing expectations that LME stocks will be drawn down to service customers outside of the U.S. in order to free up additional supply that can be shipped into the country. Traders ordered a further 7,450 tons of copper from LME depots on Thursday. The U.S. already has a huge surplus of metal in ports and exchange warehouses, but traders and analysts don't expect it to flow back out while COMEX contracts continue to trade at a premium and the threat of tariffs remain. And we have a quote from analysts at Goldman Sachs Group who said in an emailed note on Wednesday, quote, "Conversations with physical traders point to a larger than expected reacceleration of copper flows into the U.S. in the first half of 2026, and that the day's rally was, quote, driven by LME cancellations, which are likely to free up metal to deliver to the United States. A spokesperson for the LME declined to comment. So this is written on December 4th. We also had a story from Reuters. Mercuria's copper grab from LME Asia intensifies supply angst. And in the Reuters article, scrolling down, overall canceled copper warrants, titled documents conferring ownership on December 2nd, amounted to 56,875 tons, or 35% of total LME stocks. So, close to $500 million of copper is being taken for delivery on the LME, which sounds like quite a bit. And we also have a story, this is December 8th, so yesterday, from a staff writer at mining.com, copper price climbs to fresh high on China outlook boost. Copper continued its record-breaking rally on Monday amid stockpiling of the metal in the U.S., while China set domestic growth as its top economic priority for next year, boosting the demand outlook. Futures on the London Metal Exchange climbed as much as 1.3% to $11,771 a ton, surpassing the all-time high set in the previous session. So you see on TradingView, it bounced up against $5.50 per pound. Copper has been ratcheting higher in recent weeks amid a mass exodus of the metal into the U.S. in anticipation of expanded tariffs, raising concerns of a global supply squeeze. The latest spike came after China, the world's top consumer, announced it will stick with a proactive fiscal approach for 2026, lifting the demand prospects for industrial metals such as copper. And we have a quote from Xu Wengqi, an analyst with Chinese brokerage COFCO Futures, who said, quote, "The Politburo readout presents a more proactive macroeconomic environment than investors have expected. Copper will benefit from policy support toward power grid upgrades, computing power. The momentum remains very bullish." Also supporting this narrative is a dwindling supply of refined copper products due to the U.S. stockpiling. Analysts from CITIC Securities, a Chinese brokerage, said on Monday that the global shortfall of refined copper could reach 450,000 tons next year. Prices must average above $12,000 a ton next year to attract the investment needed in new mining capacity to ensure sufficient supply in the medium to long term, the CITIC analyst said in a note. So big moves in the copper market. Continuing on, silver price hits fresh record as strong ETF inflows sustain rally. And so silver hit an all-time high of $59.33 per ounce on Friday, so big moves in the silver market. And another headline, this time from Bloomberg via mining.com, silver copper eclipse gold as top metals bet on supply fears. So you can read all about both metals on mining.com. Continuing on, U.S. vows over $1 billion for Congo critical minerals supply chain. And this is Bloomberg News via mining.com, and there is a picture with a backdrop that says delivering peace, and there is President Trump and President Kagame of Rwanda and President Tshisekedi of the Democratic Republic of Congo signing the Washington Accords. So let's see the update here. The U.S. is in talks to provide more than $1 billion for two critical minerals and railway projects in Central Africa as it seeks to secure supplies deemed crucial for national security. The U.S. International Development Finance Corporation plans to support a new copper and cobalt venture between the Democratic Republic of Congo's Jeka Mines SA and Mercuria Energy Trading, as well as a rail project linking Congo and other Central and Southern African nations to Angola's coast. And we have a quote from Development Finance Corporation Chief Executive Officer Ben Black, who said in a statement, quote, "These projects will help to secure vital supply chains, expand private sector opportunity, and strengthen America's global competitiveness while supporting peace, prosperity, and dignity in Central Africa." The article continues, President Donald Trump has made securing minerals that are crucial for military and high-tech applications one of his priorities, with several deals with African countries emerging. Chinese companies dominate the mining and processing of many of these metals, and Washington is looking to loosen the Asian powerhouse's stranglehold over the trade. The DFC's announcement follows the signature on Thursday of a strategic infrastructure minerals partnership between Congo and the U.S. And we have a comment from Jeka Mines on the DFC investment. Quote, "The partnership would grant end U.S. users a right of first refusal, providing U.S. industries with access to critical minerals essential for economic growth and competitiveness. And the article continues, under the US-Congo Strategic Partnership, Congo has committed to shipping more of its minerals west towards the Atlantic Ocean over Angola's Lobito Railway Corridor. Currently, most of Congo's exports move south or east along the road or railway. And continuing on, we have a story from Reuters, and this is yesterday. M23 rebels entrench their rule in East Congo even as Trump claims peace. And this is by David Lewis, Sonia Rowley, and Julia Paravicini. And so the M23 were not a party to these talks, interestingly. Scrolling down, as it says here, the conflict in eastern Congo is one of 8 wars U.S. President Donald Trump says he has ended in less than a year. At a signing ceremony hosted by Trump in Washington on December 4th, Congo and Rwanda, which has long been accused of backing the rebels, reaffirmed their commitment to peace. U.S. officials say Western companies could invest billions of dollars to extract Congo's critical minerals once peace is secured. The conflict isn't settled, however. M23 isn't a party to the pact Congo and Rwanda signed. On Friday, a day after the meeting, heavy fighting continued on the ground in eastern Congo. And as M23 takes part in separate peace talks led by Qatar and Doha, the group is tightening its grip on power, undermining the prospect of any real end to the fighting. Under cover of the negotiations, M23 is effectively building a separate, self-sustaining government in the eastern part of Congo that has many characteristics of a fledgling state, Reuters has found. The group has a military force that has roughly tripled in size this past year, with thousands of new fighters deployed to firm up M23's hold on the territory it has seized. The group has put in place a new civilian leadership structure with hundreds of loyal officials, including new provincial governors and mayors. In a bid to operate independently of Kinshasa, the capital of the DRC, M23 is trying to nurture its own financial institutions, as Reuters previously reported. It has been fixing roads, has imposed taxes on coltan-rich mines, and is issuing travel visas for visitors to the territory it runs. M23 declined multiple requests from Reuters to comment on its state-building efforts and its stance on Trump's peace effort. And finally, we have a quote from Jason Stearns, a Congo specialist and former member of the UN panel of experts on the country. Quote, "There's no way they're going to implement any of the peace deals. Their approach to the peace process is to hold on to power as long as possible." And Jason Stearns is, of course, referring to the M23. And finally, Fred Bauma, head of the Congolese research group Ubatelli, which studies the country's endemic conflict, said he believes M23 is playing along with international mediation efforts to manage diplomatic pressure while buying time to reorganize, rest, recruit, and redeploy troops. Quote, "The way this crisis is managed will determine the future shape of the state. If the Doha peace process fails and the M23 prevails, we are heading towards federalism or worse," he said, referring to the possibility of rebels continuing to govern swaths of the East. So conflicting stories there. Continuing on, Congo sets new export conditions to keep tight grip on cobalt. This is Reuters via mining.com on December 7th. Congo has set new conditions for cobalt exporters, according to a government circular reviewed by Reuters, potentially complicating a recently introduced quota system as the country seeks to keep a tight grip on the key battery mineral. The new conditions require miners, among other things, to prepay a 10% royalty within 48 hours and secure a compliance certificate, the circular shows. The Democratic Republic of Congo replaced a months-long export ban with a quota system in October, aiming to boost state revenues and tighten oversight in a country that produces more than 70% of the world's cobalt, a key component in electric vehicle batteries. No shipments have moved since the ban was lifted as producers seek clarity and work to meet compliance rules, Reuters has previously reported. And this circular, as it's being called, is dated November 26. And then we have a column from Andy Holmes over at Reuters, Congo's attempt to control cobalt market risks becoming supply shock. This is Reuters on December 3rd. It's been almost 10 months since the Democratic Republic of Congo, the world's dominant cobalt supplier, halted exports of the battery metal. Scrolling down, it takes about 3 to 4 months to ship cobalt hydroxide from the Congo to China, where it is processed into cobalt sulfate for battery manufacturers. It's The long supply chain is why Chinese imports of cobalt intermediaries from the Congo initially held up well in the months after the February suspension of shipments. But imports have fallen sharply since May. Volumes of 50,000 metric tons over June to September were less than what previously passed through Chinese customs every month. As the supply hiatus lengthens, the impact on the cobalt processing chain grows. Even if Congo's exports resume tomorrow, the material would only arrive in China towards the end of the first quarter of next year. And scrolling down a bit further, the best-case scenario, one where exports resume in the next few days, is a severe but short supply squeeze in the early months of 2026 before deliveries to China arrive. But there is also the growing risk of a more profound supply crunch, generating another swing of cobalt's boom-and-bust pricing cycle. So all sorts of things going on in the metals and minerals sector, which continue to play a leading role in world affairs. And continuing on to another big headline, this is the Financial Times. China says it is actively issuing rare earths general licenses. And this is by Joe Leahy, Ryan McMorrow, and Andy Bounds on December 4th. China has said it is issuing general licenses for exports of rare earths in a move that could ease trade tensions with the US, Europe, and other trading partners and alleviate acute shortages that have gripped global supply chains. China's Commerce Ministry said on Thursday that it, quote, actively applies facilitation measures such as general licenses to promote the compliant trade of dual-use items and effectively safeguard the security and stability of global industrial and supply chains. As long as the export applications are for legitimate civilian use and are compliant, the Chinese government has approved them in a timely manner, a ministry spokesperson said. So we're back to the dual use. China still does not want any of their rare earths being used for military purposes. And continuing on rare earths, U.S. firms are snapping up the rare earths Europe needs to rearm. So we see the military angle, frankly the geopolitical angle, on rare earths in all of these headlines. This is Bloomberg News on December 2nd. As Europe embarks on a historic rearming effort, its defense companies are scrambling for a vital component in high-tech weapons: rare earth minerals, which more nimble U.S. rivals are scooping up. Despite a one-year rare earths trade war truce between the U.S. and China, Beijing maintains tight controls on supplies and prohibits sales to companies that produce weapons. That has made stockpiles already outside China even more precious. European rare earth supplies may begin running dry in months by some estimates and incentivize defense companies to be quick and ruthless in securing them. So far, U.S. companies have been much better at navigating that landscape than their European counterparts. And we have a quote from Tim Borgschulte, Chief Financial Officer at Berlin-based critical raw materials trader Noble Elements. Quote, if we look at how long it takes on average to sell, say, a ton of terbium to a European partner, we're talking about 3 to 4 weeks. With the Americans, it's more like 3 to 4 days. So Europe's military build-out continues to feel the pressures from the restriction on rare earths, a story we've been discussing here really since the summer. Continuing on, U.S. plans more stakes in mineral companies. Trump officials say, this is Bloomberg News via mining.com, the U.S. government plans to take more equity stakes in critical minerals companies, a White House official said Thursday, calling the once-rare move necessary to counter China's dominance in the raw materials used in everything from semiconductors to MRI machines. So expect the U.S. government to take more equity stakes in mining companies. Continuing on, EU to introduce export restrictions on rare earth magnet waste in early 2026. And this is Reuters via mining.com. The European Commission said on Wednesday it will introduce export restrictions on rare earth permanent magnet waste and scrap in early 2026 to boost recycling within the bloc as part of its Resource EU package aimed at curbing its reliance on China. Recycling could potentially meet 20% of the EU's current permanent magnet demand of 20,000 tons. Permanent magnets are critical for electric vehicles, defense, and renewable energy. The Commission also said it will mobilize $3.5 billion over the next 12 months for strategic raw materials projects that can deliver production in the short term. And a related headline, this is Reuters. G7 finance ministers discussed export controls and critical minerals in call. Canada says, so we're hearing more talk of export controls from the G7. Canadian Finance Minister François-Philippe Champagne chaired a virtual meeting of G7 finance ministers on Monday to discuss export controls and critical minerals, the finance ministry said in a statement. Quote, an important point of consensus was the concern regarding the application of non-market policies, including export controls, to critical minerals supply chains, citing significant negative macroeconomic consequences, increased price volatility, and a deterioration in global growth prospects, the ministry said. And finally, the New York Times did a big write-up on deep-sea mining and the metals company, what scientists found when a deep-sea mining company invited them in. And so I'm not sure that's a new story, but it's being brought back up here, where I believe the metals company brought in some independent scientists, and then the independent scientists, from what I recall, did not provide results that the metals company was hoping for. And the article goes into this. So that's on the New York Times. So a big show coming up today. We have the investment breakfast with Rick Rule at the International Mining Symposium just last weekend. It was a fabulous event, and I interviewed Rick and asked him all sorts of questions, including on government investment in the mining sector and what to do about that, as well as his favorite investments right now. You're not going to want to miss it, so a wonderful interview there. And also, we have Dale Vinn, Chief Executive Officer of Fortune Bay, in this week's Spotlight, who talks about the company's gold projects in Saskatchewan and in Mexico. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner, and on Facebook, LinkedIn, and YouTube, where we also host these podcasts, and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcast. And with that, let's turn to Dale Vinn, Chief Executive Officer at Fortune Bay, for this week's Spotlight. Join us today. I'm very pleased to welcome to the Northern Miner podcast for this week's Spotlight, Dale Vinn, Chief Executive Officer of Fortune Bay. Dale, welcome to the show.
Hi, Adrian. Yeah, thanks for having us.
It's great to have you, Dale. And so for those that are unfamiliar with Fortune Bay, could you give us a little bit of background of the company?
Yeah, we're a TSXV listed company under the symbol FOR. We focused on gold. We do exploration and development, and we have our flagship project in Saskatchewan. We also have another asset in Mexico. We do also have some uranium properties that are under option and partner funded, non-dilutive to the company.
Okay, excellent. And so you were saying the flagship then is in Saskatchewan. Could you go more into detail of what you think is there, how far along you are on the project? What is happening in Saskatchewan?
That's right. Yeah, our flagship's the Goldfields project. It's up near Uranium City. And just a few months ago in September, we completed an updated PEA for the project that's really set the stage for advancing it. And we've certainly got going with that. We started a drill program a couple of weeks ago. That's going to cover exploration on the project. There's some exciting new targets to expand the resources, as well as project development related drilling toward our pre-feasibility study that's underway.
Okay, excellent. So you have a pre-feasibility study underway. This is in northern Saskatchewan. How are you in terms of the social license and permitting? How is that side of things?
Yeah, we've really got on the front foot with that. Going back to us, we've been working up there for 5 years and built some strong relationships with the communities already. This last week, I'm actually in Saskatchewan at the moment. This last week, we're on a community tour visiting key communities around the project and talking about our proposed mine developments. That went really well. And, really well positioned in terms of moving it forward on the community side. On the permitting side, the project has an existing approved environmental impact statement from 2008 for an open pit development and a 5,000 ton per day mill. We'll be making some amendments to that, and we'll be well prepared for that as well. We did some additional baseline data work this year that's going to be finalized this month, and we'll be engaging with regulators early in the new year to have that previous EIS updated, which will then allow us to go to the actual permits for approvals to construct and operate.
Okay, excellent. And just finally on Goldfields, before we move on to Pomarosa in Mexico, how are you for funding on this project?
We well funded. We recently closed a bought deal financing with Cormark for $8 million. So we fully funded for our plans through next year, including pre-feasibility study and the exploration work we're doing. We're particularly excited about the exploration, got a lot of targets at our two deposits there, Box and Athona. Across those two, around 1.2 million ounces at some really good open pit grades, and looking to expand those through some drilling and some additional targets on the property. They were tested historically with some good results, but just haven't been followed up. So it's really nice to be funded now to aggressively pursue the exploration as well as advance what is already a robust development asset, through the next engineering phases as well as that permitting.
Okay, excellent. And just finally, how is it working in Saskatchewan? Is there a fair amount of interfacing, so to speak, with local policymakers? How is that working?
Yeah, it's just a fantastic framework and province to be advancing projects. I'm actually just in Saskatoon at the moment, and this week was an open house. I attended the minister's breakfast, and around the table there were numerous companies all advancing projects in the province. And you just sense from the energy of the ministries, the excitement to get projects moving in the province. So a really good backdrop to be advancing projects and a really supportive framework for doing that.
My hometown, how exciting is that? That's great to hear. And so this other project you have, Poma Rosa, it's a copper gold project in Mexico.
It's a very exciting project. It has a historical resource there, a gold resource of around 1.7 million ounces with expansion potential. There are numerous targets across the property that warrant further exploration. And that's just in these thinner cover rocks where we have these epithermal systems that are sort of gold focused. But beneath those cover rocks is this large porphyry system, which is yet to be evaluated. And that's really the copper gold side of it. So looking forward to getting some exploration started there. We're currently talking to communities. One has to establish exploration agreements before working through that process with a view to starting exploration in 2026.
And it's a copper gold project. Is it primarily a copper project then, or primarily a gold, or a combination of the two in equal measure?
Yeah, it's really gold primarily in terms of that gold resource we have and the shallow gold targets. But there is this copper angle to it, which is yet to be evaluated.
And finally, as far as just working in Mexico, how are you finding that? Of course, the regulatory regime is generally pretty good, but sometimes we hear issues of, say with open pit mining and this sort of thing. How are you feeling about the environment in Mexico right now?
Jurisdictions, it's very different to Saskatchewan, but there's still a lot of companies advancing projects successfully, both on the exploration side as well as on the mining side. We're a long ways from development there. We want to do exploration. There's just so much potential there. So in terms of the open pit scenarios, and we're not too worried about that. We do believe in time things will turn there. But we haven't even started development aspects. It's really a project with a good resource base and tremendous exploration upside, and we're looking to evaluate the full potential of the asset before deciding on any development paths.
Okay, excellent. And as far as the team is concerned, of course, with exploration, the team is important. Who's on the team? And do you have the same team working on both properties?
Yeah, we've got in-country teams for both Canada and Mexico. In terms of leadership, we actually just announced today appointment of a new CFO, and that's going to add a lot of strength for us. It's an experienced resource sector CFO. There's going to be, a lot of depth in financial expertise, market expertise. So a good addition as we advance the projects. And then I work alongside our VP Technical Services, tremendous support. And then, beyond that, we have teams in Saskatchewan looking after the exploration and development work, and then a team in Mexico looking after the community side as we work through that process.
Okay, great. So you have these two properties then, one in Saskatchewan, one in Mexico. So what is the plan? How do you go forward from here? How do you see things rolling out?
Well, next year is going to be a really exciting year for us with lots of catalysts. We're fully funded in Saskatchewan. We're doing exploration drilling on some exciting targets. So the market can expect some news releases around resource expansion targets and perhaps new discoveries on the project, as well as obviously milestones reached on the permitting engineering side. And then obviously looking to get Mexico going, and that will be really exciting to start unlocking the value on that incredible project. So lots of excitement ahead. We're going to be busy preparing for a good year next year, and we'll be ready to hit the ground running.
Okay, great. And so as we wrap up here, Dale, what is it that you want investors to know about Fortune Bay? What do you want them to take away from this conversation?
We are certainly an undervalued company with respect to the resources we hold and the stage, certainly of our project in Saskatchewan. If you look at us across peers, Saskatchewan's a robust development asset. I mean, today's gold price is that after-tax NPV is around $1.6 billion. That's has a very modest capex, a lot of infrastructure, and we're well advanced on community and permitting sides. So just really undervalued opportunity and the ability to move that project forward quite quickly. And then obviously just Mexico really almost comes for free at this stage if you look at our valuation, and just tremendous upside on that project as well. And then there's exploration on uranium projects ongoing, which is non-dilutive and has the ability to produce a discovery on some exciting projects that provide even additional upside for shareholders.
Okay, and just on that point, you do have a couple of uranium projects, is that correct?
Yeah, that's right. Well, there's actually 7, but they're bundled into sort of 2 compartments, and those 2 compartments are funded by partners at a TSXV listed company, Aero Energy, and then our Australian company looking to list next year called New Horizons. So the work's ongoing on those, and exciting to have that underway with some great partners in an area that's really exciting from a uranium exploration point of view on that northern rim of the Athabasca Basin.
Dale Vinn, CEO of Fortune Bay, thank you for joining us and sharing everything that you're working on at the company.
Great. Thanks, Adrian.
Thank you once again to Fortune Bay for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit fortunebaycorp.com. Turning to the website, big developments in the iron ore market. Iron ore shakeup begins as Simandou's first boat heads for China. This is Bloomberg News via mining.com. The first commercial shipment of iron ore from a massive new mine in Guinea is on its way to China, marking the start of a major shift in global supply of the steelmaking material. The winning youth vessel, loaded with iron ore from the $23 billion Simandou mine, set sail on Tuesday evening from the West African nation, according to data from ship tracker Kepler. It's expected to reach China by mid-January, data showed. It's amazing it takes that long. As I always say here, the real-world business of mining. It leaves now on December 9th, and it arrives in mid-January. Simandou's huge scale means its supplies will upend the iron ore trade with high-grade reserves that offer top consumer China an alternative to the dominant flows from Australia and Brazil. The mine, which is split into 4 blocks involving Rio Tinto, winning consortium Simandou, and other Chinese firms, is aiming for an ambitious full ramp-up over the next 2.5 years. The shipment comes 3 weeks after an opening ceremony that marked the start of barge loading, which precedes the transfer of material onto full-size Cape-size ships. The time it took to load this vessel highlights anticipated operational challenges as exports ramp up. And also in the steel market, Fortescue works with Chinese steelmaker on new green iron technology. This is Reuters via mining.com. And it's quite interesting because BHP spoke against the notion of green iron ore, saying it was too expensive. Fortescue wanted to go ahead with green iron ore, as did China. And one wonders, BHP has been having issues delivering their iron ore or coming to terms with China on their iron ore. So perhaps related, perhaps not. So this is Reuters via mining.com. Australia's Fortescue said on Wednesday that it would cooperate with a subsidiary of China Baowu, the world's largest steelmaker, to explore new green technology for accelerating decarbonization in the hard-to-abate steel industry. Fortescue, the world's 4th largest iron ore supplier, signed an agreement with China's Taiyuan Iron and Steel Group, or TISCO, in late November on a trial project on hydrogen-based plasma-enhanced iron and steel metallurgical technology, the company said in a statement on its WeChat account. The project aims to develop a new technology that will remove the process of pre-treating raw materials such as iron ore sintering, pelletizing, and coking, typically a large contributor to carbon dioxide emissions in steelmaking. Quote, "We are exploring the technology for green smelting using Fortescue's Pilbara iron ore," said Augustin Gus Pichot, Fortescue's chief executive officer for growth and energy. Steel decarbonization will generate growing needs for higher-grade iron ore, posing challenges for Australian miners, which mainly supply low to medium-grade iron ore. Fortescue will provide capital for the project, it said. Earlier in the year, Fortescue partnered with another subsidiary of China Baowu for green iron technology. Very interesting developments in green iron ore. Continuing on, EU risks slow demise of aluminum industry if carbon tax not scrapped, Constellium CEO says. This is Reuters via mining.com. The European Union should drop a looming carbon border tax that risks pushing its aluminum sector into long-term decline by inflating costs and benefiting more polluting overseas suppliers, the CEO of aluminum products maker Constellium said on Friday. The EU's carbon border adjustment mechanism, which will impose a levy on imports of a handful of commodities starting in January, is intended to shield European producers against cheaper rivals in countries with looser climate laws. But industry representatives see it as deeply flawed and hope the EU's final adjustments to the mechanism, due to be released this month, will address their concerns. Quote, the first thing to do about CBAM, or the Carbon Border Adjustment Mechanism, is just to eradicate it. Get rid of it, said Jean-Marc Germain, the chief executive officer of Paris-based Constellium, one of the world's largest suppliers of aluminum products for aviation, car making, and packaging. Quote, the core of the issue is the competitiveness of Europe. We are shooting ourselves in the foot knowingly, he told Reuters. Eurozone manufacturing activities slipped into contraction territory in November. Constellium mostly buys European aluminum, which is not subject to a CBAM charge for processing at its factories in the region. But the upcoming tax, coupled with concerns over supply from smelters in Iceland and Mozambique, has nonetheless pushed up European premiums for physical metal to a 10-month high. Continuing on, Italy urged by ECB to reconsider gold reserves proposal. This is Bloomberg News via mining.com. Italy was urged by the European Central Bank to rethink a push to declare its gold reserves the property of its people, a move critics say would open the door to the government selling off bullion. In a legal opinion dated Tuesday, the governing council asked Premier Giorgia Meloni's government to review the proposal following a request from Rome for officials in Frankfurt to study the matter. And here is what ECB policymakers said. Quote, the Italian authorities are invited to reconsider the draft provision, also with a view to preserving the independent performance of the basic ESCB-related tasks of the Banca d'Italia under the treaty. The Bank of Italy holds about 2,452 tons of gold, the third largest stash after the US and Germany. Following the recent price gains for bullion, some lawmakers in Meloni's center-right party proposed an amendment to the country's upcoming budget which confirms the reserves are managed and held by the central bank, but, quote, belong to the Italian people. Quote, it is not clear to the ECB what the concrete purpose of the draft provision is, the governing council said. And scrolling down, quote, the problem with this amendment is that it violates European treaties, former Bank of Italy Director General Salvatore Rossi said in an interview. Quote, approving it as Italian law means opening up a huge battle with European institutions. And I wonder politically whether this is a good idea. Some more controversy around Italy's gold and who will possess it. Continuing on, China's central bank extends gold buying streak as metals rally cools. This is Bloomberg News via mining.com. China's central bank added to its gold reserves for a 13th straight month, according to data released on Sunday. Bullion held by the People's Bank of China rose by 30,000 troy ounces last month, bringing the total to around 74 million troy ounces. The current buying cycle began in November 2024. And continuing on, shares in China's only uranium miner triple on Shenzhen debut. And this is Bloomberg News via mining.com. China's only uranium miner raised about $570 million as it debuted on the Shenzhen exchange on Wednesday, with its shares more than tripling in value. The initial public offering comes as China aggressively expands its fleet of nuclear power plants. It has the highest number of reactors in operation and under construction in the world, and may surpass the US and France as the biggest atomic power operator by 2030. And a related headline, Niger accuses Orano of radioactive pollution as uranium row deepens. This is Reuters via mining.com. Niger has accused French nuclear fuel group Orano of predatory behavior and environmental crimes, escalating a bitter dispute over control of the West African nation's uranium mines. The military-led government said Orano could face criminal proceedings for mass crimes after authorities reported finding 400 barrels of radioactive core material in Maduela near Arlit, where Orano used to operate its uranium mines. Orano, 90% owned by the French state, said it had not received any official notice of legal action and denied operating at Maduela. Quote, Orano does not hold an operating license for the Matuela site and has conducted no operations there, the company said in a written response to Reuters' questions. As it says, the row follows Niger's nationalization of the Somaire mine, stripping Orano of its 63% stake. Niger began transporting uranium from the site last week, saying it was exercising its sovereign right despite a World Bank tribunal order barring it from accessing the stockpile. Orano condemned the move as illegal and warned the shipment poses serious safety and environmental risks, saying it has no evidence the transport met global standards. Very interesting. And finally, Contango Ore agrees to $812 million deal to buy Dolly Varden, and that's by Frederick Temesco at the Northern Miner. Contango Ore agreed to buy Canada's Dolly Varden Silver to create a mid-tier silver and gold producer by adding one of the largest high-grade, undeveloped precious metals assets in British Columbia's Golden Triangle. Called Contango Silver and Gold, the company will have $100 million in combined cash, $15 million in debt, and annual cash flow from the producing Manh Choh gold mine in Alaska, a joint venture with Kinross Gold. The deal will give Contango increased exposure to silver through assets such as Dolly Varden's Kitsault Valley project. So those are your headlines. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.17%. That is 0.08% higher than last week. The UK 10-year gilt is yielding 4.53%. That is 0.04% higher than last week. Italy's 10-year bond is yielding 3.57%. That is 0.1% higher than last week. France's 10-year bond is yielding 3.59%. That is 0.14% higher than last week. Germany's 10-year Bund is yielding 2.86%. That is 0.1% higher than last week. And Japan continues to stand out here with their 10-year bond yielding 1.96%. That is 0.09% higher than last week. And again, kind of an orange to red flashing light there on Japan's 10-year bond and the potential unwinding of the carry trade as we are seeing commentators discuss. China's 10-year bond is yielding 1.86%. That is 0.03% higher than last week. So bond yields moving higher, and especially in Japan and France. Turning to precious metals, gold is trading at $4,207.80 per ounce. That is $15 lower than last week. Silver is trading at $58.43 per ounce. That is 87 cents higher than last week. Platinum is trading at $1,650.10 per ounce. That is $14 lower than last week. And palladium is trading at $1,476.50 per ounce. That is $45 higher than last week. And turning to industrial metals, copper is trading at $5.36 per pound. That is 16 cents higher than last week. Iron ore is trading at $106.42 per metric ton. That is $2 higher than last week. Continuing its climb, aluminum is unchanged at $1.31 per pound. Lead is unchanged at 91 cents per pound. Nickel edges slightly higher at $6.76 per pound. That is a penny higher than last week. Tin continues to move higher at $18.17 per pound. That is 41 cents higher than last week. And cobalt also moves higher at $23.35 per pound. That is $1.33 higher than last week. Lithium takes a breather at $13.12 per kilogram. That is 22 cents lower than last week. Uranium is trading at $76.55 per pound. That is 10 cents higher than last week, so almost unchanged. And zinc is at $1.42 per pound. That is a penny higher than last week. Zooming out, precious metals looking strong, particularly silver and palladium. Industrial metals starting to catch a bid, with copper well above $5, iron ore moving higher, cobalt moving higher, tin standing out, with nickel continuing to languish. And that will be interesting in the context of our discussion coming up with Rick Rule. And those are your metal prices. Coming up, I'm very pleased to present my interview with Rick Rule at the International Mining Symposium. Of course, Rick Rule is a world-renowned investor and speculator in the natural resources sector. We had a little bit of audio issues at the beginning. They have been ironed out as the conversation moves on. There's a lot to sink your teeth into on this one, so I hope you enjoy it, and I will see you on the other side. Has had a huge year, and of course natural resources themselves have had a very big year, topped the news cycle since April. The tariffs on China and the restriction of rare earths, it was already a big priority, but it seems to just be dominating the headlines as we saw in the last G20. It's just become matter of fact. So Rick, with all that in mind, you've been following this beat for 47 years, we just learned from Anthony. How do you read this story that's happening here? What does it mean for you?
That's a loaded question. I suspect with regards to the most recent move in gold, that it was fairly easy to forecast. It was a coiled spring. People were frustrated looking at the gold price not moving when the whole circumstance that existed in the world was a circumstance that would cause gold to move. And I think what you've seen in the last couple of years really is a catch-up move. I think that the conditions precedent for a move in gold have existed for a very long time, and that people didn't recognize it. But it's interesting when people say to me now, the move in gold, I sort of say now, you mean the one that occurred in 2000? Remember that in 2000, gold was $253 an ounce. And gold increased in price, albeit in leaps and bounds, for 25 years. It was only the dramatic move that came to people's attention. But I would observe for this audience that, in fact, gold has done its job for 25 years. It's increased at 8.5%, 9% compounded for 25 years, which is to say, at least in real dollar terms, not nominal dollar terms, it's at least maintained its purchasing power in a circumstance where other mediums of exchange haven't. And so I would regard what's happened in the last 2 years as really being gold playing catch-up with its own fundamentals. With regards to the other industrial materials, my suspicion is in the very near term, they're ahead of themselves. What you learn with the other industrial materials is, although a supply shortage is absolutely inevitable, we can talk about why that is later, industrial materials are economically dependent. And my suspicion is that, as an example, the relative weakness in the oil price and the relative weakness in the copper price suggests that the global economy is weaker than people think it is. You could have supply shortfalls if you have a demand shortfall and the price doesn't move. For people who expect the same sort of follow-through in the industrial materials that they've seen in gold, my suspicion is that they have to be more patient. They have to wait.
And bringing it to gold, you've said in the past, you're either a contrarian or a victim. It's a zero-sum game. And so when you see, the popularity of the gold narrative, how do you reconcile that with being a contrarian? Are you looking at the sell button?
I love this question because for most of the world, including institutional investors, they can't spell gold. It's a 4-letter word. The move in gold has us excited. It's like you go to in the US, you go to a Pentecostal church and you ask the choir if they believe in God. I mean, give me a break. But there's none of us. There's none of us. J.P. Morgan Chase authored a study that suggested that the market share of precious metals and precious metals investing in the U.S. market, not globally, was 0.5%, which would suggest that gold's market share in terms of investment and savings products in the United States market was 0.5%. To put that in context, that was down from a 4-decade mean, according to J.P. Morgan Chase, of 2%. So if interest in gold merely reverted to mean, demand for the stuff would increase 4-fold. So when you talk about gold's popularity, What you're doing is you're talking about the popularity of God in a Pentecostal church where they already believe. But the attendance in that church is still fairly small. Because, A, I'm a credit guy, but B, because I'm American, I think of the gold price in the context of the competition, which I would describe as the U.S. 10-year Treasury. And despite the fact that I'm American, I wouldn't own a U.S. 10-year Treasury. If it were given to me, I would sell it and use the proceeds to buy something intelligent. If I can't bring myself to own the principal competitor for gold, why would I sell my gold?
Speaking of the treasury market and bonds, of course, Jeffrey Gundlach, I was reading this morning a headline where he was saying 25% allocation to gold is not excessive. I mean, this is head-turning headlines for those who are in the Pentecostal church or who are converted already, or Ray Dalio, suggesting 20%. Are you beginning to be concerned about your contrarian stance when you hear that?
I expressed concern 8 weeks ago with regards to the share prices of some junior mining stocks. I saw companies that I didn't think should be able to be financed in any circumstance have oversubscribed private placements, where I thought if they were able to raise money at a penny, they'd be overpriced. And they were able to raise money at 85 cents with no warrants. That caused me to sell 25% of my juniors 8 weeks ago. I decided that for me personally, what I wanted to do was de-risk my portfolio. I wanted to sell risk, which everybody else was buying. By the way, I didn't deploy too much out of the sector. I took half the proceeds, bought a basket that included gold, Wheaton Precious, Franco-Nevada, and Agnico Eagle, high quality. By selling 25% of my juniors, I recouped all the capital that I had invested in the sector since the year 2020. In my own viewpoint, what I did is I sold off 25% of my upside and I eliminated my downside, which seemed like a hell of a trade to me. There are a lot of people who would be ill-advised to follow that because they didn't have a big exposure to the sector. But for me personally, a hell or high water investor, the idea that I could give up a quarter of my downside and eliminate my downside, while at the same time going up the quality trail, seemed like a good print for me. Understand that most gold bull markets follow the opposite trajectory. They go from the best of the best down the market cap and quality trail. I just decided that the lower end of the quality trail was too hot at that point in time. All kinds of financings, grossly oversubscribed. Companies calling me up saying, we'd really like to see you on the share roster. You're a marquee investor. And then telling me that the private placement was going to take place at market with no warrant. There seemed to be a contradiction between price and value that was expressed in the market. And I think that continues today.
Yeah, I want to get into that a little later, how we deal with investing and financing the sector, because you've brought this up a few times. But before then, one of the big takeaways for me last year when we spoke was when you mentioned nickel and lithium as being some of your favorite investment opportunities that you were looking at. And of course, as you say, being a come hell or high water investor, you were, looking at these hated sectors. Nickel's below $7 a pound. Lithium has recovered somewhat off the lows in the summer at $8 a kilogram to $12 a kilogram, but still well below the $50 a kilogram. Are you still looking at lithium and nickel? If not, are you looking somewhere else?
I've definitely pressed the button on nickel. Sulfide nickel deposits have treated me extremely well in my lifetime, and so I'm predisposed to like them for perhaps more than technical reasons, because, personal experience. With regards to lithium, I love hate. I don't think lithium is hated enough yet. People mistook the lithium market that we had as having a shortage of elemental lithium. We had a shortage of processing capacity. At the beginning of the lithium boom, SQM, then the most efficient lithium miner on the planet, said in their annual report that they had 85 years of proved reserves at current lithium demand. What we had was a shortage of processing capacity. We've now addressed that shortage of processing capacity. We raised hundreds of millions, if not billions of dollars to look for lithium. Surprise, surprise, we found some, probably 150 deposits. Those deposits probably worked at $50 or $60 lithium. They have difficulty in today's environment. And I think 5 of the 150 probably make it to production, which means that there's more hate that has to be expressed in the lithium market. When lithium comes to be regarded as a 4-letter word, with one caveat, that caveat being that direct lithium extraction doesn't work. If direct lithium extraction does work, in other words, if Chevron and Exxon and Berkshire Hathaway can recover lithium from saltwater brines that are coincident to geothermal or oil and gas extraction, then the game's over for a very, very, very long time. Remember that I was brought up in the oil and gas business, and we regarded lithium as waste. We called it scale. It was the stuff that fouled up our drilling and producing equipment. So there's not enough hate in lithium for me yet, and I'm afraid, not from humanity's point of view, but from the industry's point of view, that Exxon and Chevron and Occidental and Mid-American will learn how to recover lithium from waste brines, in which case it's over. On the nickel side, sulfide nickels, I'm all over them. I'm just all over them. I think before I came here last year, I mentioned to you that I had flown over the lateritic nickel mines of southern Sulawesi.
You did. I remember that.
And, nobody's going to mistake me for Greta Thunberg. But I got to say, the environmental devastation that I witnessed from that plane was remarkable. And I don't believe that the Indonesian government or the Indonesian people, or to a lesser extent the Filipinos, will allow that to go on for too much longer. And what I think will happen is that the costs associated with mining those lateritic deposits responsibly will raise the cost curve fairly substantially. I would also point out, Adrian, that lateritic nickel recovery is extremely energy intensive. And I'm a believer personally that energy prices, including oil and gas prices, rise inexorably for 3, 4, or 5 years, which will itself lessen the cost advantage enjoyed by the lateritic nickel producers over their sulfidic counterparties.
So would you add oil and gas then to your list?
I think the oil and gas business for 5 years is an absolute no-brainer.
Fascinating. And in terms of your investment thesis, I recently interviewed Jay Martin, and as far as I understand, a mentor of Jay's, and he talked about how he had a 2 to 5 year horizon when he looked at investment, when he had an investment thesis. And so my question for you is, what is your time horizon when you think of these theses?
It's wild. When I was a young guy, I had lots of time left on Earth. I had very short time horizons. Now that I'm charitably closer to the end, I've become more patient. It isn't that my time preference has changed. I think, I've graded almost 100,000 portfolios in my life. I grade them for free for people. Well, I hope I've taught people a lot about their portfolios. I've learned a lot too. And what I've learned is that one of the most common flaws that retail investors have, and probably institutional too, is that very often the strategy's right. There's been 3 decades of underinvestment in copper, so you're going to have a copper production shortfall, so the price is going to go up. But that circumstance takes 5 years or 6 years or 7 years to play out. So people will have this perfect strategy, but their tactics are shitty. Although it'll take 5 years for the investment thesis to play out, these people have trauma holding stock over a long weekend. And if you don't juxtapose the tactic and the strategy, you still fail. Think about an exploration stratagem that's explained to you by an exhibitor in the other room. They're trying to answer some unanswered questions. So it may be that they have a surface anomaly. And the unanswered question is, does mineralization extend to depth? So they're going to drill, 10 holes or something to prove up the surface anomaly. If it's in the Golden Triangle, that's likely 2 drilling seasons, which means that in order for you to get the benefit of the success that you're anticipating, you have to wait 1.5 years. If you prepare your mind to understand the time frame that is required to get the result that will give you the share price escalation that you deserve, you have to understand that you need to own that stock for 18 months. Too many people think that if you get a good result from the drill hole, the stock will go up, but they don't anticipate to hold the stock long enough to get the result that they're buying. It's totally insane. Totally insane.
So to rephrase the question, would you say 2 to 5 years, or do you adapt to circumstance?
Well, certainly I adapt to circumstance. Certainly if I own a stock where I've got 2 or 3 good drill holes and I'm anticipating that the subsequent drill holes will be good, I allow myself to shorten my time frames. But one thing I do in every circumstance, whenever I buy a stock, I do a 1-page handwritten memo to myself about why I bought it, what will cause me to sell it. And I refer to it repeatedly. Every time that the reason to own a stock goes away, irrespective of price I sell my stock. I believe that exploration in particular is the process of answering a series of unanswered questions. And if I'm approaching a no answer, then there's no reason to own the stock. Many people buy a stock without any real understanding of why they bought it and what would cause them to sell it. And the consequence of that is that if the exploration effort becomes unsuccessful, people say, well, I'm going to hold the stock till I break even. Well, why would you break even? You follow where I'm going with this? So I think the circumstance dictates to me what my likely holding period is. What I do right is I try to juxtapose the necessary holding period with my own desired holding period.
Speaking of stocks, one of the big challenges that in a sense, the society is facing as a whole, one could argue, is finding the right projects to invest in. This is as much a government issue as it is an investor issue. So you have a lot of experience. You have a huge amount of success in this space. How do you start looking for companies? Is it basically a Google search where, let's say you're interested in lithium, for example, or nickel? You start, looking at the companies. Do you talk to your friends? What is your process for, determining a company that has something that you find credible?
Yes, and yes. It really depends on what part of my portfolio I'm cramming the stock into. If it's my investment portfolio, which is populated by the likes of Franco and Wheaton and Exxon, what I try to do myself is build a very, very, very rough net present value model. I try to familiarize myself with the probables pipeline, and I try to decide if the corporate culture and the balance sheet is intact to translate that pipeline into net present value. And then I try to decide whether or not the package is appropriately priced. It's all value consideration. Nothing else matters to me. Coming down the quality trail as an example, all the way down the quality trail to the exploration side, I don't believe that the exploration business at its heart is an asset-intensive business. I believe it's a technology business. I believe it's an intellectual capital business. And so for me, it's all about the people. Early stage, it's all about the people. If I were to get a call from the third generation of Lundins, mercifully, I've done business with the first two generations, and so I'm a Lundin addict. If I were to get a call from them saying, Rick, we have an idea that we think is a pretty good idea, but it's in a pretty strange place. The market might not like it, which is why we're calling you. I'd be on that like white on rice, just like white on rice. What you discover in technology, and this is going to sound very elitist because it is that Pareto's law works. How many people in the audience know what Pareto's law is? Most of you. It's the social science dictum that goes around the 80-20 rule, where 20% of the population does 80% of the work. What you learn in large populations, in large tasks, well, you learn two things. First of all, that there's a good 20 that does 80% of the good stuff. There's a different 20 that you don't know too much about, the 20% that creates 80% of the aggravation. So it's a bell-shaped curve. But your first job is to hang out with the good 20 and avoid the bad 20, right? The second thing that you learn is that if you take both the good and the bad lips and you run them through the same performance dispersal curve, they conformably align. How do I say that in English? 20% of the 20 do 80% of the 80, or 4 or 5% of the population base generates 65% of the utility. What I learned at about age 50 is that you can run that same performance dispersal curve at least one more time, so that 1% of the population generates 40 or 50% of the utility in any given task. What that means in junior mining or in molecular biology is that 1% of the people assigned to the task generate almost half the utility. Therefore, if you hang out with the 1% and you ignore the rest of the population, you work less hard and you're successful more often. So for me, it all begins with people. I also like scale. I've learned in our business, in the mining business, that everything that can go wrong with a small mine can go wrong with a big mine, but a small mine can only ever make you small money. So why would you take big risk for little money? And then I've learned two other things. In order to really compound my gains, I need to be involved, hopefully, in a commodity that everybody else hates, because then I become the only check writer. I'm not competing with Eric Sprott, which is a lousy thing to have to do. And I also like countries that other people don't like. I take the view My apologies in advance to the government people among you. I take the point of view that the most dangerous government is that which is closest to you, that every jurisdiction is bad. Every jurisdiction is bad. But some are priced as though they are more bad than others. My greatest experience personally with political risk occurred in the People's Republic of California, where I was then resident. I had the misfortune of being part of the Viceroy discovery, 7 miles on the wrong side of the California-Nevada line. And it took us 13 years, and if my memory serves me correctly, $17 million in bribes being campaign contributions, functional bribes, to put that mine in production. And yet my peers in California were telling me that Congo was risky. So I would say that those are the 4 secrets to whatever success I've enjoyed: scale, people, a focus on out-of-favor commodities, in particular uranium treated me well when nobody liked it, and my willingness to take what other people would describe as excessive political risk.
Fascinating thoughts on jurisdiction. In a sense, to boil it down, though, as a lot of retail investors like myself like to do, I mean, is it as simple as, Robert Friedland's involved, it's gone down, it's a buy?
It can be. I mean, it can be. You're going to have, as a guest later today, Clive Johnson, serially successful human being, a great motivator of people. But you have to time Clive correctly. After Clive sold BEMA, formed B2, if my memory serves me correctly, he awarded himself and his team about 100 million shares of stock for being Clive Johnson. Nice work if you can get it. I didn't allow myself to participate in the subsequent financing because a 25-cent financing didn't seem cheap against 100 million shares at a penny. Fast forward 5 or 6 years till Clive had been able to grow B2 and disappoint the market, then yes, absolutely. After the water that Clive had assigned himself was amortized over successful efforts in raising a whole bunch of money from other people, perhaps less prudent than myself finally, it became a function of that. I remember you mentioned Robert Friedland. I remember at one point in time, Ivanhoe Mines had already made the Kamoa-Kakula discovery. They had already attracted Jockmeck for $200 million into 10% of Platreef. They had 99 cents a share cash in it, and it was selling for 63 cents. So I had 2 spectacular deposits. The market had verified the value of one, and the company was selling at a 35 or 40% discount to cash in the treasury with the best mining promoter since Cecil Rhodes. There are some points in time when the market is really, truly ringing a bell, and that was one.
Okay, excellent. I want to bring it back to financing and especially the financing of exploration companies. I mean, one of the big tensions I think we're seeing right now is the problem, in a sense, around financing. In a sense, you've said in the past that they've been overfinanced, a lot of exploration companies.
Way overfinanced.
But at the same time, what we've seen is a kind of state-run capitalism coming out of China, where Congress just put out a report in November about, predatory pricing, and how China is basically, they argued, subsidizing, whether through low-cost loans or favorable circumstances. And what we've seen is actually China does dominate many, if not most, of the metals markets. So how do we reconcile this issue? Because it seems like in the West, we are moving towards, more of a state-backed minerals and metals industry. What do you think?
Well, I think that the Chinese are doing today what the United States did in the 1950s and 60s. They're pretty good students. The idea that the United States is accusing the Chinese of being fascist is highly amusing to me. It's true, of course, because they emulate our playbook. While the U.S. government hasn't always directly subsidized the mining and the oil and gas business, it is arguable that there have been points in time, including in the early 1970s, when the U.S. State Department was an unpaid arm of U.S. extractive industries globally. We object to it when it's done by people who aren't white, who do it better than we do. But that objection is probably fairly disingenuous. I also personally believe that over time, the government has the ability to foul up anything that they get involved in. And I don't think the Chinese government is any different than that. If you look at the opacity with which the Chinese government runs their banking system, or the opacity around the municipal development of real estate in China, I think probably that's a portent of the future that the Chinese will enjoy in the mining business if they continue on their current course. Over the last 10 years, or really 20 years, Chinese participation in mining has been pretty smart. They have found high-quality entrepreneurs and high-quality teams like Zijin, and they've done two things. In terms of building mines in China, it can often take 4 or 5 days to get permitted, as opposed to 4 or 5 decades. That's certainly helpful. They have also used the mechanism of the Chinese state to, if you will, smooth the political relationship between the Chinese mining industry and host communities around the world. Nothing that the U.S. government hasn't itself done in the past. The fact that the Chinese now do, as a matter of course, what we did as a matter of course, but have now made it a felony, is something that is interesting for us to criticize the Chinese about. The second part of the question is more amusing to me, which is to say, the social change around extractive industries, particularly in the United States in the last 5 or 6 years. In the Biden administration, a guy like me had some fear of finding his picture on a post office wall. We were really, truly vilified. And now the morons want to subsidize us. I have to say, I felt cleaner when I was vilified than I do now being subsidized. And I would urge the mining industry to be very careful what you welcome. To the extent that you encourage a deeper government nexus in your business, you may find that to be extremely unpleasant in the next election. Can you imagine the fondness that, as an example, in our country, AOC would have for mining? How would you like AOC to be the largest shareholder of your development company in Alaska? It doesn't seem very pleasant to me. Separate and apart from that, I am not really familiar with an awful lot of success that either Carney or Trump have had in investment management. And the idea that Carney and Trump propose to manage my money in resource investments is something that drives me absolutely effing crazy. I don't need them. I don't want them. My belief is that the mining industry would be better off if Rule invested Rule's money in mining than if Trump or Carney invested Rule's money in mining. Unfortunately, they have guns.
Isn't that, though, what we had for the last, 20 years was a market-based, free market, everybody can do what they want?
Do you have a pulse?
I was like, we still have 5 minutes, Rick. Don't worry. Again, feel free to correct me if you see things differently, but I mean, it seems that we had 20 years of a free market, so to speak, perhaps in words more than actions. And look at the results. It looks like China is dominating almost every metal. So in a sense, what should policymakers do? If not nothing, perhaps that's the answer, right?
Yeah. You had a fascist regime there who saw it in their interest to go through the same process that the United States went through in the 50s and 60s and 70s. In other words, their political priority was to establish access to natural resources. You had fascist regimes in the West who became redistributive. The process is the same. The desired outcome is different. The idea that we had a free market in the United States in my lifetime, let's just say I take issue with it.
Fair enough, in a sense. If that's the view, then it's like, then we haven't had a free market.
From the mining industry's viewpoint, I get where you're going. I just object to it. From the mining industry's viewpoint, you have a lower cost of capital if Trump provides the capital or Carney provides the capital than if Rule provides the capital. From society's viewpoint, you would rather Rule provided the capital. From the mining industry's point of view, the mining industry loves dumb money. And you have this whole new munificent source.
Okay, so here's kind of an interesting question, too, that sometimes crosses my mind in our final 3 minutes here, Rick. Are you concerned about an overbuild at all with all of the priority that's been given to natural resources by Western governments? You could argue just around the world, beyond the West. Are you concerned about an overbuild at all?
We will have it, but likely not in my lifetime. I'm, for the record, a very healthy 72-year-old. The cure for high prices is always high prices, and the cure for low prices is always low prices. In copper, as an example, we've underinvested in the whole copper production cycle for 3 decades. And it will take a long time to accommodate that underbuild. The consequence of that is that at some point in time, we'll have fairly high real copper prices, and capital will be attracted to copper. Once we really start looking for it, we'll really find it. And once we really start building it, we'll build it. And at that point in time, it'll be overbuilt. And when it's overbuilt, it'll be extraordinarily popular. You'll see it on the cover of all kinds of magazines, and the investment banks will trot out all kinds of new copper crap. Very, very, very predictable. The cure for low prices is always low prices. Cure for high prices is always high prices. The process that you get from one to the other takes a long time, longer than most people know, and it's extremely messy, but it's extremely easy to forecast.
Excellent. And as we wrap up here, kind of a fun one, what is the most cutting edge thing you're seeing in the mining, metals, minerals industry? It can be technology. It can be a particular metal that's specialty that nobody's talking about. What's really turning your head, as you wake up and go to the office?
The passing of the torch from folks like me who came into the business in the early part of the 70s, skipping a generation, your generation really, and going to younger people, watching young leaders who have come into mining from sensible businesses, who were forged in very, very tough times in the mining business, looking at a business that is increasingly not white, not for ESG reasons, but simply because the non-white people have chosen to come into the mining business when white people didn't. Seeing a business that's increasingly female, it has nothing to do with ESG. It has to do with the fact that young female technologists are extremely competitive with their male counterparts. Watching a market-driven transition in human resources in mining and extractive industries generally from a generation, looking at me, that's well past its prime, skipping a couple 20-year gradients and watching the reins change to a younger generation that is, in my experience, in every regard, more competent than we were.
Rick Rule, CEO of Rule Investment Media, thank you for joining us. Thank you once again to Fortune Bay for sponsoring this week's episode of the Northern Miner Podcast. You can learn more about Fortune Bay at fortunebaycorp.com. And thank you once again to Rick Rule for appearing at the International Mining Symposium. It was a true delight to talk to someone with such experience in the sector. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcasts directory. Share it with your friends. And until next week, take care.